I mean, I appreciate how many commentators were perma-bears 3 days ago, and now all of a sudden recognized, wait a second, this was a trading anomaly. This was more 1987. Maybe the jobs report isn't as great as we thought, but this was really an opportunity for folks to tell you what they thought interest rates should be, not what the data was. Yeah. But that doesn't mean the worst is over yet. I mean, the economy is clearly in transition. It is cooling, and we're not entirely certain how to make that transition elegantly. But the Fed is certainly working at that, and they're going to work hard to try to make that transition soon.
Yeah, one wonders then, because the fundamentals haven't changed here, right? Especially for this market. AI trade still seems to be the key factor for future growth. The only problem is that people are just worried about the capex on that. But it's supposed to flesh out to some of the other players in this market too, and that doesn't seem to be in play either. So when you look at this market, where exactly do you then find opportunities then that are sufficient enough to still make all those fundamentals and more make sense?
So I think if you went on holiday on Wednesday and showed up today, you'd say, well, probably not that much different than where I was last week, right? You can't look too much at what happened Thursday, Friday, and over the weekend because there just wasn't that much news. That said, I think folks have recognized maybe being all large tech in your portfolio might be a bit of a mistake. We're finding a lot of folks still having comfort on the short end of the U.S. sovereign curve, so T-bill and chill, as we've been saying. Still pretty good when you're looking at 4 to 5% return as you work out where exactly do you go on the risk spectrum. We see a lot of interest in corporate bonds, particularly mid and intermediate term corporate bonds, because those companies are healthy. They are going to continue to make their debt payments. They're going to continue to make higher coupon payments. From the equity side, it's hard to really look at the large cap U.S. space and say, that's not for me yet. That trade still makes sense. We forget that drawdowns are inevitable. 95% of years in the last century have a 5% drawdown. 1 in 4 have a 25% drawdown. So these short-term trading anomalies, that's just part of being in the market.
The hard part to work out is whether we are heading towards a recession, if you actually believe that, number one, because if you look at the Atlanta Fed Watch GDP now, running at 2.9% on GDP. I mean, how do we get to recession when we're at 2.9%?
I agree. I think the recession indicator from the Somme rule was misread. Even Claudia Somme was out sort of inoculating folks ahead of time that was based on there being too many people being forced out of work, not more folks looking for work. And GDP numbers are strong. There are cracks in the economy. There have been for a long time. There always are. But I think that recession indicator was overread. And if we look at raw growth, it's still there. So I don't see that happening just yet. That isn't to say, though, that traders won't create a downdraft where the Fed now has to act that may inadvertently force a recession. But this will be that interaction. Now, can the Fed, the BOJ, can they work together to try to stave off traders from hurting themselves?
That's a good point, isn't it? Because recessions can be caused by elements away from the economy. And we saw it in the financial crisis in terms of the markets, the lending, what happened in banks. And we saw it around the pandemic, even though it was a brief recession. It was a pandemic, right? It wasn't the economy that caused a recession here.
It's like a run on a bank. Most runs on banks happen not because the bank runs out of money, but because everyone's afraid there'll be a run on the bank. And I don't want to see a recession caused because of that, and I think that's the message that most folks are trying to process now.
That said, if you look at what's transpired in recent decades, it's been an economy or an environment that's not been allowed to go into recession. Central banks, governments have all stepped in to avoid some sort of trough, almost avoiding any deep fall in the economy. So even if we were heading in that direction, is it right to even think about recession investments at this stage?
It's probably always smart to keep some of that in your portfolio. And some of the items that should have been resilient during a big fall like Thursday, Friday, Monday, they tended to work out. So being well diversified was a good reminder. And I think folks forgot about that for a while. So good news there. But that said, I think the government policy is going to continue to want to avert recession. Recessions are bad for politicians to get reelected. So anything they can do to keep through that, they will. And until the Treasury auctions no longer have high pull-through rates, I think that policy is no reason to be changed.
Did this earnings season matter at all? Or was this somewhat of a catalyst of the downturn we saw in the early stages and then a whole lot more news kind of shifted things along?
Yeah, I've asked the question, has earnings season mattered for the last year or so, where earnings seem to be on one trajectory, the economy on sort of its own, and the correlation seems to have been missing. I think earnings here look pretty much like they have the last year or so if you pull back from the noise. If you beat expectations, you did well. If you just met or slightly underperformed, you were penalized pretty severely. maybe more so this quarter than last quarter, but you usually see 10 to 15%. Now you saw 15 to 18, so not that far off the mark.
One wash up for me was that you are seeing the bifurcation in the US consumer. I mean, Airbnb out overnight also talking about some of the softness they're seeing in their numbers. We heard it from the athleisure side. We already had warnings early on from the likes of Target in the previous quarter. How cautious are you around the low end part of the consumer market in the States?
I think I've been more cautious than most for a long time. It seemed that this was a lot of consumer credit. Many folks were out there buying things maybe they couldn't afford or just didn't need, even if they could afford it. And we're seeing some of that come out. There was a lot of recession or sort of pandemic era spending that habit hadn't died yet. I think we've now killed off some of that. And those companies had substantial and higher than average growth for a long time. That just can't keep up forever. And I think we're seeing some of that being pulled out of the market.